Thank you for joining me here for this training. This will be an entire hour on what's your program worth. This training is going to help you understand the exact things that you need to be looking at if you are looking to grow your program or understand what the true value of your program is, particularly if you are looking to sell that program or even if you're looking at an exit strategy 5 to 10 years from now. On the other end, if you are an investor, these are the elements that you need to understand when you are doing due diligence on the program. As many of you know, my name is Nick Jaworski. I'm the owner of Circle Social Inc., the leading consultancy and marketing firm within the addiction treatment space. At this point, we have over $100 million of marketing data, and we have close to $1 billion of operating data for treatment programs across the country at all sizes and levels of care. We work with and have consulted with the largest providers in the country. We also work with a large number of small to medium-sized programs across the country as well. So we have become the largest owner of data, as far as I know, in terms of addiction treatment and what's working, what has worked in the past, as well as what's working now. And then in terms of actually having the qualitative skills and analysis, we are in different treatment programs at least every 2 weeks across the country, big and small. We've helped build out the largest marketing teams internally in some programs. We have run those programs ourselves. We have help with business development. We have help with call centers. We have help with back-end tracking, the clinical protocols, you name it. We are involved in every single aspect of our clients. And so when we are talking about what works for a treatment program and what aspects you have to understand to truly understand the value of that program, we've got the quantitative data and we've got the qualitative analytical skills. So I want to share that with you today. I am a big believer in making sure that this space is moving forward. There is a ton of need right now within the addiction treatment space. We need better providers. We need successful providers that will be here not just next year, but 10 years from now. And so as the addiction issues continue in this country and across the world, we need to be effectively combating that. And running a successful program is one way to do that. And help you understand what creates a successful program is what will help you understand what creates value in that program. Whether you're looking to sell or you're looking to buy, this is a big piece of what we'll be talking about today. A distinction I want to make, something that I think is very important, especially within this space, is this idea of a zombie company or a zombie addiction treatment center. And so this is a term that you'll often hear from people like Warren Buffett or Sam Zell, billionaire investors. They look at companies, and it's the same thing that I do when I'm looking at a facility or looking at a program and saying, is this program really worth anything? And if it is, what's it worth? Because within the addiction treatment space, there were so many of these zombie companies. And a zombie company is a company that has never really been successful, but it got lucky. It just was created at the right time. And so basically the zombie is sitting in the water and it's going out with the tide, right? Or it's going downstream with the current, you can think of. And so because it's going with the current, it's going to be successful simply because the current's moving in that direction. And we saw this tremendously common within addiction treatment. It was so easy to make money. Reimbursements were so high. The cost of entry and the barriers to entry were so low that almost anybody, even with the most unsuccessful business model, even with the biggest, most bloated budgets and just bleeding money everywhere, could still be profitable. That is a zombie company. That's a zombie addiction treatment center. They are simply going with the stream, with the immature market, and almost anyone that got into that market was going to be successful. A valuable company is a company that can go upstream, that can go against the tide. And it's successful because it has a number of assets in place, it has a number of advantages in place that allow it to be able to survive when times are tough, not just when everything's going in a positive direction. So that's what I'm going to help you understand today, is what you need within a treatment program, whether you're literally a 6-bed detox or whether you're running a national program with facilities across the country. A lot of these fundamentals are the same. And the fundamentals are the key to having a successful valuation and to growing the valuation of your program. So what is valuation? I know a lot of people from the addiction treatment space in particular don't necessarily understand the language of finance. And so when the investors come in, there's two languages being spoken. So let's get on the same page here and make sure that everyone understands what we're talking about when we're talking about valuation. The most common term that you'll hear is EBITDA. That's earnings before interest, tax, depreciation, amortization. Simply a way of removing kind of the accounting decisions or some of the financial decisions from the profit equation, right? Your depreciation, your amortization, these are accounting decisions a lot of the time in terms of when they will be realized on your balance sheet. And so to simplify that process, a lot of investors will use EBITDA as the standard. So when we're looking at valuations, the valuation for your treatment center could be 3x of EBITDA, it could be 10x of EBITDA, and going through this training will show you what you need to do to make sure that you're not getting 3x, but you're getting 10x. Or if your treatment center is not profitable at all, what you need to do to even get to the 3x standpoint. There are different considerations that can come into place when you're actually determining the value of a treatment center, but this is the most common and it's the one that you're going to need to understand. So if you understand EBITDA and you know what your EBITDA is for your facility, you are making a big leap forward in being able to understand what the potential multiples are and what the potential value of your actual business is. You have your standard liabilities and assets. So I mentioned that here, it sounds really simple, but usually when people think of assets, they're simply thinking of things like real estate. There is a lot more that goes into the assets of your facility. The assets can be clinical protocols, it can be talent retention, it can be the marketing channels and the diversification or the brand reputation that you have. We will go into each of those elements specifically, but assets are far more than just the things that you own, just your cash flow, just your real estate, etc. And then liabilities and risks are also a big part of a variety of different elements that most people don't quite realize. And what I've come to understand personally within the addiction treatment space is that even a good number of the more sophisticated equity partners out there, the more sophisticated investors don't really understand addiction treatment. They don't understand what makes a good company, and so obviously that's why we get called in to do the due diligence, we get called in to do the valuation, because there is a gap in the knowledge, and that's fine, that's what we're here for. The risk profile is obviously super important related to liabilities, so you have cash flow going out, you have these expenses, but what are the potential risks in the future that your center has to be protected against or has to be actively mitigating? We're going to go through those in specific detail very shortly here. And then what's the timeline for a potential upside? Obviously, the only reason anyone is ever going to buy a treatment facility or a treatment program is they want to make money off of that program. Nobody wants to go into it and lose money. So if you're trying to sell it for 10x, 10 times of a $2 million EBITDA, but if we look at the timeline, it's going to take us 10 years to make that money back, that's not a good investment. No one's interested in that. And so it's very important to understand that you have to be selling your program for a price that's appropriate. Yes, everyone would love to get 10x or everyone would love to get 30x on their treatment centers if they sold them, but that's not reality, and that's not going to create a partnership understanding with a potential buyer. We deal with a surprisingly large number of facilities that are literally losing money, and they're trying to sell their programs for ridiculous amounts of money. That makes absolutely no sense. No one is going to buy a program that's losing money. So how do you make sure that you're profitable? How do you make sure all these other assets are in place? How do you make sure you're mitigating risk so that someone else that comes in can potentially buy it and be profitable in a reasonable amount of time? I want to just take a little minute here to thank Bob Kuzanovich. He's the one that originally kind of walked me through this. If you don't know, he's one of the senior execs over at Hazelden. But this is your provider profitability, and it's something that I use all the time when we are evaluating treatment programs. A huge mistake that many treatment programs make is they usually look at their cost per admission as one of the key metrics that they focus all their attention on. It's a horrible idea. Cost per admit is only part of overall profitability. So we'll look at this here at this slide, and then our next slide gets into a little bit more of our revenue tracking as well. So our cost per admit should be at most 3 times our average daily reimbursement per patient. And what's really important to understand is that it's a blended cost per admit, or CPA. All right, so it's not talking about just AdWords, not just talking about just business development. I'm talking about combining all these factors, understanding my overall marketing spend, and then understanding what my blended cost per admit is across my diversified marketing channels. That's my cost per admit. That needs to be lower than 3 times what my average daily reimbursement is. So if my average daily reimbursement is $500, I should not be paying more than $1,500 as a marketing expense to acquire new patients. That's what investors are looking for. And that's also just really good business operations from an addiction treatment standpoint. Length of stay, obviously, okay, if I get patients in at the right price, but I can't keep them, it doesn't matter much, right? So if I'm paying 3 days worth of reimbursement to get them in and they're only staying 2 days, I am losing money. Length of stay is critical to the success of a program. Are they staying 30 days? Are they staying 60 days? And then finally, your average daily reimbursement, right? The more you get paid or the less you get paid for a patient in your facility, the more or less money that you're going to make. Now, what's critically important here is to understand that each of these has different teams that are responsible for them. And again, a lot of treatment centers focus on their marketing. Some of them sometimes focus on their call team. This is the wrong way to be understanding center profitability and to making sure that you are pulling the right levers to increase profitability within your program. Length of stay is owned by the clinical team. We literally were just talking to a program that their clinical team was kicking people out at 50% of their length of stay that was approved by the insurance provider. So they were getting 30 days, the clinical team was kicking them out after 15. As you can imagine, this resulted in hundreds of thousands of dollars of losses per month, and this wasn't caught until it had been going on for about 6 months. So we'll talk about shortly, but there is a very, very important need to be tracking daily your census and your profitability, and we'll show you an example of how that's done. So clinical team, they were kicking them out for all the usual reasons. They weren't appropriate fit for the program, they were fraternizing in the facility, they felt that this wasn't the right time and they weren't ready, all these reasons that, you know, a poorly trained clinical team will provide for kicking someone out of the facility early. Also, AMA rates were high, right? There was not protocols in place to identify AMAs and then intervene and address those patients to help them get through difficult times. So length of stay was very low, which led to a very low profitability and some serious losses in overall revenue during that period. So on top of the clinical team, we have, obviously for cost per admit, we have our marketing, we have our admissions department, we have our business development. Now, it is insanely important to understand that these people work together. The worst thing you can do, and it's illegal now anyway, is to give a particular target to a business development rep, a call center admissions rep, or your marketing team and say, you are solely responsible for the admissions you bring in. That's ridiculous. That's not how successful marketing works. It's not how successful programs build. Your marketing team is going to work in conjunction with your call center team, which is going to work in conjunction with your business development team to drive a lower cost per admit. Now, when we do consulting, we get into the nitty-gritty of this, so we understand which call team or which team is performing, which members of those team are performing, what's going on with the marketing, what's going on with the business development, right? You can get very, very deep and granular into understanding what's working or what's broken. We're not going to have time for that in this training, but it's just critical to understand that these teams are working together. Your marketing department can bring in leads and inquiries, but if your call team can't convert them, it doesn't matter. Your business development team can do the same. If your business development team does not have reputation that's supported by the marketing team, they're going to bring in less referrals and less admissions. Very easy example, if I'm running Facebook campaigns for a client, if we're running TV or radio, that will boost the number of referrals coming in from the business development team. Marketing is supporting business development and they're working in tandem. So all three of these business units have responsibility for cost per admit. No single team is directly responsible for all of it. Average daily reimbursement is a mix of the clinical and the billing team. So length of stay and average daily reimbursement are very much dependent on the documentation and the utilization review in particular that your clinicians are providing to the payers. If you do not have good documentation, you are not going to get reimbursed. You are not going to get the levels of care approved. You're not going to get the lengths of stay approved that client needs for their greatest chances of success and recovery. So your clinical team has a critical role in both length of stay and average daily reimbursement. Of course, your billing team also has a role in average daily reimbursement. Are they submitting on time? Are they working with the clinical team to understand utilization review and documentation? Are they working through denials? Are they helping you with in-network contract negotiations? The billing team has a lot of different levers that they can pull to increase profitability for you and to make sure that they're working with your clinical team to get those average daily reimbursements from the payers. So all these teams work together. All these teams are very, very important in understanding profitability. Tracking revenue, very common quote by Peter Drucker: what gets measured gets managed. If you're not measuring the stuff, you're not managing it. We had a treatment provider in California that was literally paying 60% of their overall revenue towards interest payments, which we'll get into in a little bit here. But there are very, very important things you need to be tracking within your program all the time to make sure that you're not losing ridiculous amounts of money for no reason. So there's cost per day or cost per bed. For example, if we're looking at an out-of-network provider, I want to keep my cost per bed down under 500. If I am in-network, I want to keep it under 300, right? You know, as an example, within a residential facility or a detox. This is going to vary based on if I have variable cost or not. So a lot of providers have very fixed costs in terms of operating expenses and labor. You might as well do a cost per day analysis. If you have variable costs, particularly around labor, which tends to be 30 to 50% of a lot of treatment providers' overall costs, then you can do a cost per bed analysis rather than cost per day, because if you have less patients, then you have less staff and your profitability is a little bit different. But you need to be tracking what your costs per day are. Then obviously you need to know your revenue per day, and we'll show you a tool shortly is one way that you can do that. But revenue per day, you obviously subtract the cost per day from that and you get your profit for that day, right? So we can understand what we're actually making on a daily basis. Now, this is important for catching these issues that can pop up, and we'll show you another really clear example shortly here. Statistically, it's not very valid, right? It doesn't really help me to understand my day-to-day profitability. All day-to-day profitability does is it helps me realize gaps or realize problems before they become long-term problems. So from a monthly standpoint, a quarterly standpoint, a yearly standpoint, this is much more effective data in understanding the long-term profitability of my program. But for short term, I can kind of analyze some of these problems that are going to occur. And then obviously I need to know my average daily census. For the love of God, please have your EMRs and your CRMs tracking this kind of thing. There should be some kind of system in place. It should not be tracked on an Excel sheet that no one looks at or that multiple people are adding to, because it creates a mess. So, you know, make sure that you actually have the systems installed in your program to aid this tracking. Probably one of the biggest things that we do when we go into a program is help them understand how to track effectively, because so many have a mess all over the place. So this is one of our clients in Texas, this facility in particular that we're looking at here. And this is a very good example of oftentimes we will get calls, and the problem we always hear is we need more calls. We need more admissions, right? We're losing money. I can't tell you how often the case is that the marketing is probably one of the least of their worries at this current point in time. So this particular client has a fantastic tool resource here that we can make available to our clients to do daily revenue tracking. It's a fantastic tool. And so as you can see here, what has happened is we are in this particular facility, we have detox, residential, and PHP. This is actually for the month of July. And so in July, we can see that we had a lot of PHP here. We can see that our average daily reimbursement was about $6,700. So for this particular treatment provider, this was not a profitable number. So that's problematic. So now what do we need to do? We need to say, okay, look, PHP is not reimbursing at a rate that's really profitable for us, so we need to cut PHP out and bring in more residential and more detox patients. Another thing you can look at is in-network versus out-of-network. For this particular client, we actually pushed the marketing more towards out-of-network, and so we were able to increase by 42%. Remember right off the top of my head, the number of out-of-network patients that they were bringing in just by making sure that their marketing was more integrated, more diversified, and more strategic in the way it was being done. So this is the beginning of July. We see here we're looking at these average daily reimbursements of, let's say 6,500 on average. We move to the second half of the month. We've cut PHP out. We said we're not really going to take on patients for PHP. And as you can see here, as we get towards the end of the month, $7,500 a day, $10,000 a day, $9,000 a day. So we've had almost an 80% increase in revenue at this facility just by recognizing the fact that we needed to cut PHP out of the mix. We had another provider that we just worked with in California, very similar situation. They thought that they had issues on the marketing and their call admission center end. We went in, there was issues around their clinical, around their billing, and around the way that they did their financial tracking. Within a month, we were able to triple their revenue simply by making corrections in those areas. So it's very, very important to understand that your marketing is just a small piece or a section of what needs to be understood for profitability. And when you're doing things like daily tracking, you can catch issues around revenue, around profitability, around costs that you might not be able to see on a month-to-month basis. So again, this is a fantastic tool. It kind of creates, almost replaces the need for a CFO, particularly for smaller facilities. This is something that we provide to clients. It helps them a great deal. So if this is something you're ever interested in, feel free to reach out. Let's get into risk factors here. There are a lot of risks, and risks are things I do not want as an investor. I want to mitigate those risks as much as possible. I'm looking for a positive risk reward profile, right? One where the rewards are greater than the potential downside. And so whenever I'm looking at investment, I need to understand what those risks are. And if you are trying to sell your program, how can you make sure that those risks are mitigated and it makes your program more attractive? Now, a charismatic leader is one of the most common that you see with smaller facilities as well as older facilities. So if you go to the NATAP conference, for example, you will see a lot of what I refer to as the old guard. There are a lot of these older nonprofits that have been around for 50, 60 years. Many of them are dependent on a charismatic leader. The charismatic leader has been in the field, often within the 12-step circles, for, again, 50, 60 years. They know a lot of people. And so because they know a lot of people, they're trusted by a lot of people, they get a lot of referrals, Those referrals generate the vast majority of that business. If I were to buy that program, that leader is probably going to leave, right? They will take their cash buyout and they'll say, okay, thank you, I've done my time, I'm moving on to something else. There go all my referrals. That is not a successful business investment. I do not want to invest in something where the entire business is dependent on one person, or the vast bulk of the business is dependent on one person. And it's also not scalable, right? Why do a lot of the old guard nonprofits really never get above 30 beds, 100 beds? They can't scale it because they're very dependent on a particular leader to drive a bulk of the referrals, right? It's not a program that a lot of investors want because they want a platform that they can use for growth, to build multiple facilities, to grow bed counts, things like that. That can't be done with the charismatic leader. Another issue with the charismatic leader is they tend to be doing everything sometimes. So especially with smaller programs, if you're looking at your little 6-bed detoxes or your 30-bed residentials, this leader doesn't quite know how to delegate, right? They attract certain talent to them, but they're doing everything. They're got their hands in the marketing, they have their hands in clinical, they have their hands in the operations. That's not successful because, again, it's not a scalable program. And if that leader is removed from that situation, multiple business units are going to collapse. That's not something I want to buy. So a charismatic leader is actually a big risk factor for a potential buyer or acquirer because it means that there's not a lot of value with the business outside of that person's ability to continue to drive that business forward. You have legal, current and historical, right? Pretty obvious here, but things around patient brokering. Really great examples if we look at Liberation Way. Became City Line Behavioral Health for a little bit there, bought by Fulcrum Partners, etc. Had to completely be shut down because of all the legal issues that the previous owners, who they had sold it to, got into. So huge loss of money there. because things were not adequately assessed from the legal end and a historical basis. As a buyer or an investor, I don't really want to get involved in anything that is going to have excessive legal risk. All right. Another point of the legal risk aspect is compliance. So particularly when we're looking around things like HIPAA or CRF 42, those are very, very important. If you are not compliant with these areas, then there's a good chance that you have the potential to be sued, right? And HIPAA could be the government, CRF 42 could be a civil or personal person filing these suits. So there's a lot of risk in all these directions. But the more that I can mitigate the legal risk and the compliance risk, the happier I'm going to be as an investor. Lack of assets is a big deal. We mentioned this in the beginning. It's not just real estate, your diversified marketing channels, referral relationships, talent, and network contracts. All of these things are assets to the business. All of these things give you a durable competitive advantage and a safety net should things go south, or if you have to move this business upstream, right? The more competition that comes in, the harder the business environment is, and so the more assets we need, not just for the safety nets like real estate, but for growth potential, like the marketing and the referral relationships. High debt is obviously a big no-no. You know, you definitely shouldn't have more than 30% of the business leverage at any given time. I personally prefer under 15. You know, it really depends on your particular business model, but high debt is usually bad. You know, if you're looking and you're paying 15% on loans that you have out there, that's a big deal, right? That is very hard to get on top of. That eats into your profit significantly. So do you have lower interest on the loans, right? You know, like I said, the one program that we had in California, I mean, they had ridiculous amounts of their monthly revenue going towards interest payments, and they didn't even know it, right? I mean, literally like 60% of their total income was going to interest payments. It was just killing the business. So high debt is obviously a bad idea. Geography is important as well. So the more geographically dispersed you are, the higher the risk. It is harder to manage geographically dispersed organizations. It's much more expensive to market geographically dispersed organizations, and it's generally less valuable for clients. This includes dispersed organizations when you're looking at your multi-facility programs and facilities across the country. It also comes into account for the flyaway model, right? The flyaway model is not particularly effective from a clinical standpoint. It's very, very hard to market. There is a lot of risk associated with the flyaway model. I've talked a lot about why it's a bad model and why it's been dying, and rightly so. So when we're looking at geography, we're looking at your market cap, right? So market cap is what is my potential for admissions within a particular geographic area. If I look and say, okay, this city has 100,000 people in it, and I know that 20% of those people, so 20,000, are probably struggling with addiction. But I also know that only 10% are going to seek treatment. So 20,000, 10% of 20,000 is 2,000. So I know that every year, maybe 2,000 people are going to seek treatment. So that lets me know that I might be able to build a 100-bed facility in that place, but I'm not going to build a 300-bed facility because there's a market cap on the geographic area. Competition also comes into a factor there. I've got 2,000 people seeking treatment, and now we've got 4 different providers, all with 100 beds each. That now means that we have 400 beds available within that particular geographic area. We have more supply than there is demand. That's a problem. That's a risk. So I need to understand what the market cap is for that geographic area. I need to understand what our competition is, what they're doing, and then we'll look at assets shortly in terms of how we can actually combat competition and hopefully take greater market share. But geography is really important. A huge mistake, and the way that the majority of the industry grew was flyaway models and geographically dispersed. They basically operated as holding companies. So each single facility was almost its own business. There was really no connection, no synergies between any of them. That's a problem for a lot of different reasons. It's something that we've helped a lot of programs work to correct or work to avoid because it's just not very sustainable and it's just super expensive to try and make it work. So avoiding those situations, if you are in that situation where you have geographically dispersed facilities, what can you do to start bringing them closer together? Or how can you actually set up your operations on the back end to support that dispersion? It's not easy, but it is definitely possible. So we've understand the risks, but what are the assets? What are different ways to increase the value of our program? Clinical is always number one. This is probably one of the biggest challenges for investors, for private equity firms. They know clinical is important, but they don't understand how to quantify it. They don't really have a qualitative understanding of what good clinical looks like. It makes it very hard for them to assess it, and so the thing that they're usually looking at is outcomes tracking. So outcomes tracking is one way to tell about the effectiveness of clinical protocols and clinical programs and clinical staff. Outcomes tracking is tracking that happens at your center, right? What is general feedback from people in the program? Are they staying in the program? Are they AMAing? What's their feedback related to groups? What's their feedback related to clinicians? How are they feeling on a day-to-day basis? Are they staying sober on a day-to-day basis? These are important outcomes, but much more important are the outcomes after they leave the facility. How long are they staying in recovery? How much improvement are we seeing in terms of their general moods? Are they getting employed? Are they gaining entering to further in education? Did they find a general practitioner? Are they compliant with their medications? Are they reducing their ER visits? Is their general health improving? All of these things are really important outcomes that we can be tracking that will show the value of our program and the effectiveness of our program, because an effective program is one that will ultimately be successful. Alumni is a great example of that and something that investors are starting to look at more and more. A really good clinical program will drive up to 20% of admissions coming from alumni. And I'm not talking about people relapsing and coming back into the center. I'm talking about alumni loving the program, loving what you did for them in their life, and then referring other people to you so that you can help treat them as well. That's where an effective clinical program really becomes obvious. And then obviously you're going to have professional referral partners referring to you more because they saw that the union that sent someone, the government agency that sent someone, the hospital, the clinician, the therapist, they sent someone, they saw a really good result, they're going to refer more people to you. So referrals allow you to understand that your clinical program is good, but outcomes tracking makes it very definitive and it gives it a quantitative analysis is very, very important to help us understand and evaluate a program. Talent is really important. As everyone knows, it's very, very hard to find good clinicians. And when we're looking for good talent, we're looking for retention of that talent. If you can't keep clinicians more than 4 months, that's a huge problem because that means that you're having to rely on clinical protocols and matrices and back-end operations to support the clinical development rather than the skill of the clinician. And the skill of the clinician is hugely important in terms of delivering quality clinical treatment that's effective. On top of their own talent, then you're looking at the back-end clinical protocols and trainings that support those clinicians to allow them continuously to improve what they're doing, as well as to allow them to easily get on the same page and align around things like clinical methodologies or effective treatment. Talent and your training and protocols work together to build a solid clinical team. And when those are working well and you're retaining staff, that has a lot of value because it will show in the outcomes. As we mentioned before, all of this works together to increase length of stay. So if you have a higher length of stay, you are going to have higher profitability within your program. Increasing value from the marketing and business development standpoint. So again, a lot of people here really don't understand effective marketing for addiction treatment. The majority of providers are looking at it from a lead generation or an inquiry generation aspect only. This is the wrong way to look for a long-term profitable business. I don't care if you can generate calls if you are only generating those calls from sources that you don't own. So if I walk into a program and it's all call buys, right, there's no long-term value for that because those call buys could stop working. That call center could completely disappear. That call center could decide to open their own treatment program. You don't own those leads. Additionally, you've built up no reputation with any of that marketing. You've just paid for it. It's completely lost. AdWords is another great example of that. I'm paying for AdWords, it's bottom of funnel, final decision making. There's not a lot of brand that's built up there. And so for that reason, it's something I have to constantly pay for. It's not adding value to my business over time. So sometimes programs will try to fluff their numbers by pumping up AdWords, or they'll pump up call buys. We all know that the quality of those calls sucks, right? AdWords, if you're converting at 1 in 100, call buys, if you're converting at 1 in 150, you're doing pretty well. So I don't really care if I have 60,000 calls if you're only converting 200 of those people into admissions, So investors are pretty smart. They now know that game. They know that people are trying to fluff their numbers by upping call volume. It doesn't really matter if your call volume is high if it's not converting. And it won't convert unless you have effective, diversified, integrated marketing that's also building up reputation. Multiple channels is absolutely critical. As we mentioned, I can't be over-reliant on a single channel. How many programs did we see close down when AdWords stopped working? There was up to 20% of some programs in some areas in Florida, California, and Orange County. The hilarious thing is that AdWords is a really poor, really expensive marketing channel, and it also should never be more than 10% of total admissions into a program due to the high cost and the lack of long tail reputation building advantage. So it's ironic that so many programs were trying to rely on it. The funny thing is that we have looked at the data extensively, and we even go into the biggest programs in the country, the vast majority of them were not generating a significant number of admissions from AdWords, and most of them were paying insanely high cost per admissions from those channels. So that creates a problem, because then as insurance reimbursements drop, they don't have the revenue coming in to cover the significantly high costs of AdWords, for example. So multiple channel means I want business development running, I want Facebook running, I want AdWords running. If I can afford it, I want TV and radio running. I want to be doing PR. I want to be building relationships with referral providers. All of these things are valued because it's not important just to get in one channel worth of admissions. Volume is critical for long-term stability, success, and growth. I would much rather have admissions coming in from two channels, let's say AdWords and business development, rather than AdWords alone. The biggest mistake a lot of programs make is they do single channel marketing. They say, okay, this is working now, this is the lowest cost, we're going to put all of our money and all our effort into that. It's a horrible idea, because what happens when that channel stops working or it doesn't work as well as it used to, you need to make sure that you have different throttles that you can move up and down, and that can be AdWords, Facebook, radio, TV, business development, referrals, whatever it is. You're making those all work together so that you have a lot of volume coming in, and you have that diversified volume so they have long-term sustainability. So if your business development referrals are not doing particularly well 1 month, you're still okay because you have 4 other channels that are delivering admissions. And maybe you can push some more money and effort into those channels to make up for the gap that's currently happening with business development. The other really critical piece that, again, most treatment centers don't understand is that these work together. My TV and radio campaigns can literally drive 2 to 3 times the number of referrals and admissions from business development, not from the calls directly off those ads, which is silly because no one ever sees an ad and just calls. When was the last time you bought a car after you saw a TV ad? Like, it just doesn't happen, right? For some reason, addiction treatment seems to think that that happens. But these multiplier effects come into play when everything's working together. Even simple data like we have on the back end with AdWords will show us that 20 to 30% of all people that visited an AdWords landing page from an AdWords ad actually go back, research the business, and then call from the SEO channel, for example. So it looks like it's coming from Google Organic. It was actually originally initiated by an AdWords campaign. So you never ever want to be reliant on final attribution, which is what the vast majority of programs do. You want to understand how your channels integrate and work together to build a diversified, solid strategy that ends up being an asset to the business over time. Referral relationships are very similar. We had a client that we were working with that had one single referral relationship driving 60% of their business. Then their business development rep soured that relationship through some negative actions, and they lost overnight 60% of their business. That is a risk. That is not something that we want. And so a really effective treatment program is going to have diversified referral relationships as well, just like they have diversified marketing channels. Then those become assets. Because if I can get 3 referral relationships that are driving, let's say, 10 admissions a month each, now I have 30 admissions a month, and that relationship is something that someone else can't get. So it's an asset, right? It takes time. It's very difficult to build relationships with referral partners, especially things like unions or government agencies or Native American tribes, for example. All of these are very difficult to get into. So because they're difficult to get into, they build kind of a fortress or defense network around that referral relationship. It's an asset to your business. It's something that's going to add value to your treatment center if someone else is looking to buy it. Talent, just like with clinical, the same thing. I need talent that's effective. I need them good at what they're doing. And so when we look at things like business development, I want people that are really good at their jobs, but that are really good at their jobs working with our program. A huge mistake a lot of programs make is they look for this book of business crap that has never really worked. And so they'll say, okay, well, this person has a big book of business, so let's pay them more money and bring them over here. Well, it's an issue because your book of business is related to that person and not to your particular facility or to your brand. And so that person, the second they get offered some more money, they will leave and go somewhere else. Additionally, most of that book of business is tied to another treatment provider. Really easy example, we had a client we were consulting with that had just done that. They had just brought in a high performer from another very large treatment provider that was bringing in 22 admissions a month. Brought that person over, that person couldn't bring in more than 2 admissions a month. Had been bringing in 22 admissions a month for over 2 years. And they moved to a new program and couldn't bring in more than 2. They kept them on for 4 months and could never get them above 2. So the book of business doesn't translate because it does not connect to the rest of the marketing that's being supported with the business development team. Brand and reputation is absolutely critical to the good valuation of a treatment provider. This is probably one of the things that the vast majority of treatment providers don't understand. It's also something I'd say a lot of investors have a hard time grasping because there's not a quantitative analysis that can be built around it. However, your most successful companies are going to be the ones that have reputation and brand. Very simple example, if I decide that I need treatment and across the street from me I have a Hazleton Betty Ford Center and I have, let's say, Serenity Recovery, right? There's a million Serenity Recoveries in the country. Which one am I going to go to? I'm going to go to Hazleton because I know it, right? I've heard that name before. I've seen it somewhere. If I research it online, it comes up everywhere. That brand, that reputation is essential to the success of that business. So I've got these 2 logos here. Really good example. Let's say that I want to buy a car. And I decide to go buy $20,000 to $30,000 for that car. On the back end, I can tell you that we can buy user intent data. We know what people are looking for. We know who's in the market for a car, so we can run specific ad campaigns to those people. So that happens to you. You're in the market for a car. You start seeing advertisements for Ford showing up in your Facebook feed, showing up on Google, getting direct mail campaigns for those. What's the likelihood that you're going to buy a Ford? Possible, right? You like Ford. You know it's a quality company, you consider the price reasonable, you know that you can get it fixed, or if something goes wrong, they'll at least guarantee the warranty on it. So at the same time, you're also starting to see ads for Psych Motors here. So Psych Motors is showing you ads for their car, same price, $20,000 to $30,000. It's actually a little bit less. Let's say it's $15,000 to $25,000. Are you going to go and buy a Psych Motors car? Because you saw the AdWords for it, because you saw a Facebook campaign for it, because you saw it on TV. You're not, right? You have no idea who Psych Motors is. There's no reputation there. The brand is driving a significant portion of the business. People are making decisions before they even see ads because they're already familiar with the brand. So brand is a huge asset to a business, and when it's there, it allows that business to be very, very successful and drive low cost per admissions, as well as supporting the other marketing channels, like your business development. If anyone's curious, Psych Motors is a Chinese car company. Cost per admission is obviously key. If you have a long-term low cost per admission, that adds value, that's seen as an asset because it says that you have effective marketing that's sustainable over time. Continuum of care is also critical. Really, we're looking at what the payers want. The payers do drive the majority of this field, whether you like it or not. It's a reality. And what do the payers want? They want people to offer full continuums of care. Why? Because it's better for the patient. If someone goes to a detox in Orange County and then flies to Phoenix, Arizona for residential and then gets kicked over to South Florida for IOP, how is that benefiting the patient? There's no continuum of care that's happening there. They're being flown over all over the place. right? It's not effective. The payers do not want to see that, as I've been talking about for almost 3 years now. And people, started paying attention about a year and a half ago when it started happening. The flyaway models, the out-of-network reliance is not a long-term strategy that people want to invest in, because it's not what the payers are going to pay for. It's also not clinically appropriate, right? The best clinical care is going to come from a full continuum of care within one provider within a specific geographic area that's near that person's home. Research is very clear on this. The closer it is to someone's home, the more likely that treatment is to be successful. There's very few cases, mainly celebrities and some other high-profile individuals, that can benefit from flyaway care. Most people benefit from geographically local care. So I want a full continuum of care, ideally. A lot of treatment providers have tried to get around this by networking with other providers in the area. That's a starting point. That's okay. But I'd get a higher valuation, and it's considered better from an investor standpoint if you have integrated levels of care across the board. The payers are very clear that's what they want, and they want the lower cost, right? Payers do not want to pay $30,000 or $25,000 for 28 days of care when they can see outcomes that are similar or just as good at local IOPs or local OPs. And so they will always pay something for detox and for residential, but it will continue to be less. It will continue to be less providers that are actually granted those contracts, and so it's not a sustainable business model. We want full levels of care within a geographic area from a single provider. Other assets, in-network contracts are a huge asset that everyone's looking for. The more in-network contracts you have at a good reimbursement rate, the better, right? That's easier said than done. But if you have several in-network contracts that have significant reimbursement rates that are very profitable, then that's a huge asset, because those are very hard to get. The harder something is to get, the bigger of an asset it is to the business. Owned real estate, obviously that provides that safety net. So if the business does go south and the operating company is no longer that valuable or cash flow goes down, at least I can sell the real estate for something. There's a lot of opportunity there that provides safety. So I want that asset in place. Legal and compliance programs to mitigate all this additional risk. I don't want HIPAA issues. I don't want CRF 42 issues. I don't want issues from patient brokering in the past. I don't want people defrauding Medicaid, right? All this shady stuff that treatment providers were doing in the past. I need a legal compliance program in place to make sure that's not happening at my facility, because it could be happening under my nose if I am not accurately monitoring what my staff are doing and what we are doing internally. And if I'm not have my program reviewed by a lawyer. There were many cases of people doing illegal activities that were not aware of it being illegal, like waiving deductibles, for example, or flying people in. So you have to be aware of it, and that's going to happen by hiring in the right legal team to at least provide you the initial assessments and compliance program training. So legal compliance is huge. HIPAA compliance is huge. It prevents a lot of liability. Most programs are very poor at HIPAA compliance. You see a lot of programs, when you go into them, they are texting PHI and PII together. They are emailing it. Both of these are big no-nos within the different regulations, both federal and state level. So make sure that you have the compliance programs in place. That's it. That's the end of the training here. I hope that you really did find it valuable. I hope it gave you a much clearer insight into what you need to be looking at in terms of what makes a program valuable and what all the different aspects are that can add to the value of a program. This should also give you some insights, whether you're looking to sell or not, whether you're looking to buy or not. If you have a treatment program now and you're looking to be able to try and grow it, if you focus on these different areas, I guarantee you they will allow for successful growth, or they will allow you to turn around a failing center. To learn more, please get in touch with me anytime. I'm very active on LinkedIn. I'm very responsive on email. Those are probably the two best ways to reach me. But I do very much enjoy what I do. There is a lot that we need to do across this country to help people in recovery, and it has been my mission for years now to really improve what we're doing in this field. And so this training is just one more way that I hope I'm able to do that.